Investing in commodities, the next chapters, the market participants are hedgers, speculators, arbitragers. There are issues like storability and reusability. We have something called the convenience rate. The monetary between holding a physical commodity versus being long on the equivalent future contract is called convenient yield. You have capital assets, storage cost, consumable transfer. All of these things matter on how you price these commodities. So we have two terms, contango and backwardation. In contango, the return term structure has a positive and the future prices is above the spot prices. Contango rise when buyers dominate the future market. Backwardation is a negative trend when the future prices are lower than the spot price. Investor can take profit by taking long way subsequent holding until maturity. So something is getting cheaper, then investor can profit from taking long position in successive future contracts and hold them until maturity because you know about the pricing. So you know that in future the price per barrel is going to come down. Another factor influencing the future price is the extent of convenience yield, which reflects the benefit of holding physical commodity rather than a contract in future delivery. Convenience depends on the level of commodities inventory on the market expectation and relation between future and forward prices. Return components of commodity is spot return, roll return, collateral return, and rebalancing. Spot return refer to percent change in commodity spot price globally depends between supply and chain. Roll return is income generated as we close maturing future contract and replace with newer. Collateral return corresponds to interest received on cash path. Rebalancing return is when we consider portfolio rather than individual. I have the roll return, model for expected return, and so on. So a relatively small chapter. Uh, so I'm repeating some of the points that I did, and then we'll look at the questions. So CAPM, because commodities are not capital asset, CAPM is inappropriate to model them. Insurance perspective, a long position commodity will earn positive return due to the speculator premium earned to the support short hedger. Hedging pressure hypothesis, a risk premium can be earned on either long or short position depending on the balance of hedger. Theory of storage, according to theory of storage, commodities that are difficult to store should earn a positive convenience yield. So according to theory of storage, commodities that are difficult to store should earn a foreign convenience yield. Commodity future, structured product on commodity future are ETF, commodity index certificate based on commodity. Contango and backwardation. Backwardation, the term structure will have negative yield, future prices will be lower than the current price. Normal backwardation, the future price lower than the corresponding expected spot price occurs when hedger are short in the future market. Contango term structure has positive slope, the future prices is above the spot price. Here the total return is spot return plus roll return plus collateral return plus spot return is percent of change commodity price. Roll return is closing out maturity and replacing them with newer. Collateral return is when invested in government securities. Rebalancing is additional return on portfolio commodity futures. And there are no numericals here, only this much we have.